Hello, my YouTube friends. I hope you're doing well. Today we're going to talk about buy low, sell never. My main strategy and what I do for my investing. We'll get into that today and I'll talk to you about how to grow wealth and the best way I see for doing those things. So stick around. Good morning. My name is Adam Kahn, and I'm the Rational Investor. Today is Sunday, March 31st, Easter Sunday. Happy Easter for those of you who celebrate Easter. I hope you're all doing well. It's a little bit chilly here despite it looking beautiful, which is why I got the big heavy shirt on. Um, I hope everybody's enjoying their Easter, spending some time with family, which is what we'll do today. But before I forget, before I get into the buy and hold or buy and never sell, buy low, sell never technique, do me a favor if you haven't already, hit that subscribe button, smash the like button, make some comments. Let me know what you guys think and what you do to help grow your wealth and the things you find that helps you. Buy low on great companies, sell never. That's really the strategy I try to implement. And I use a little bit of a Peter Lynch technique, as well as that I actually pay attention to the markets and I watch them. You can go full on Peter Lynch. And for those of you who don't know, he essentially says just find great companies and invest in them. And don't even worry about price because in the long run, it'll work out. Stocks have ups and downs. If you pick great companies, even if today's pricing isn't wonderful and you wait 20 years, you should be in a good position. And I wholeheartedly agree with that. And I try not to overanalyze because I think that having a little bit too much information sometimes can be worse than just having some general information and knowing what you want to invest in. Now, I do add my own technique into it where I try to pay attention to prices. I was a floor trader at the Chicago Mercantile Exchange for a long time. So it's hard for me to get that out of my system where I do pay attention to the ups and downs. I try to look for a situation where really good companies have bad news that comes out or even good news that drives the stock lower. I try to be a little bit more cautious about the good news that drives the stock lower because there's something in there telling me that it's gone too far. If you're getting really good news on a company and a stock continues to go lower and lower, something's not adding up that I try to sniff out and I try to be careful of those situations. But if you have a great company that you're aware of that has bad news come out and it pushes the stock lower, from there, I don't necessarily buy immediately, but I try to give it some time to where I think it's just sat at those lows for a long time and the news has subsided and they're not really talking about that bad news anymore. And my hope is the sellers have exhausted themselves and the stock can start moving higher. Now, keep in mind, this is not financial advice. As always, I say you guys need to do your own research and make your own decisions in investing in companies. What fits for me may not work for you. And today's video is going to go into a bit of the stocks that are largest in my portfolio and how they became that way, as well as why I stick with them and the things like that, on top of how things transition over time and how the portfolio changes. I'm also going to talk about the three different accounts that I have and what I do with those, which I know I've talked a little bit in the past about, but there's real reasons that go into it. And the first story I'll get into really explains why I have a majority of stocks in what I call a safe deposit box. Now, it's an account that I don't have online access to, and I would need to pick up the phone and call the financial advisor and ask him to make changes in it. And those of you who don't have a financial advisor, I'm biased. Mine is my brother, but we were both, when I traded at the Chicago Mercantile Exchange, he was a trader at the Board of Trade. He stayed in the industry. I kind of moved on, and while I stay in finance because I enjoy it, and he and I talk about it all the time, I do other things as well while he went into financial planning. But the fact that I have to pick up the phone and call him and ask him to do something, like, those are extra steps that I don't really want to do. So it forces me to just leave those stocks in what I call a safe deposit box. I also can't have access online to make trades or do things. And that's a little bit on purpose. And it's also how his company is set up for security reasons and everything else, which I really like in today's world where security becomes a bigger issue. Now, I'm going to tell a story about my buddy Steve and I, and that is his real name, but he doesn't watch my videos, so he's not even going to make a comment on it, I think is funny, but it's bad too. But we talk this stuff all the time as well. A few years back, when Amazon and Google and Meta were all three out of favor and fell below $100 each, both of us were sitting there having a conversation about in the future. Now, we were talking 2 years, 5 years, 10 years, 20 years. We think all of these stocks are going to be at $1,000 again someday. We don't have a projection as when, and maybe we're wrong, which is why I say you guys need to make your own decisions. But these are all great companies. And we kind of had a conversation of, geez, why wouldn't we just buy them and leave them and not pay attention? Because both of us like to trade. Well, I told him that I have three different accounts, one of which I think of as being in a safe deposit box, and suggested he did the same thing. But I actually followed through with that advice and I put on a decent position in all three of those stocks. Meta, and I think it was called Facebook when it was back then, has done phenomenally well in a very short amount of time and has become my largest position. Why? Because I leave it in the safe deposit box. We both bought a little in the accounts like E-Trade where we have access to it. I no longer have those shares. I know myself well enough to know if it's in my position or possession, forgive the slip. But if it's in my possession, I have a tendency to buy it when I think it's gone too low, and maybe I sell it when I think it's gone too high. But once I do that, it's very rare that I actually buy it back on a little bit of a dip. And I really believed the things we were talking about when they fell below 100. I really believe one day they'll be at $1,000 a share. And that might be 10 or 20 years out, but that's why I say when I buy low and never sell. Uh, the only time I think to sell is twofold. If something changes fundamentally in those companies where I no longer want to own them as a company. And at least at this point, nothing has changed in any of those three companies. The only other thing that can change for me is as I get older, maybe I want to move into dividend paying stocks to just pay for retirement. If they become large enough and I'm getting to the point that I really don't want to work, I feel like I'm getting close to feeling like that, but I still enjoy my job. And I don't like it's not that I've gotten good at it where I don't find it to be stressful or that difficult and I don't overexert to try to grow or do too much. So it's nice to have something to go to and do. And most of the time, I'm able to watch the markets and do this stuff as well. But in the meantime, while I still want growth, I leave the companies in the safe deposit box. On top of it, I don't make changes as they go higher on purpose. I've watched companies like Microsoft and I've watched Apple and I've watched others over 10, 20, 30-year time frames where potentially they just keep going and going. So if Meta happens to be one of those companies and it just continues to explode over the next 10 years, I don't want to readjust the portfolio so it doesn't become too large a percentage. A lot of people have these rules of I don't want any stock being more than 5% or 2% or whatever percentage they think is too much of a portfolio. Well, if that were the case and they bought Apple in the 90s or something similar, they would have lost that potential for it to just make them really wealthy and not worry about it. When I bought the companies I bought, I put in a dollar amount I was comfortable with. That hasn't changed. I still invested the same amount of money I did when I did it. The fact that it's gone up how it has, really, I don't want that to impact my decision. And that's also why I keep that in that specific account. I don't want to be tempted to make any changes. If Meta is fortunate enough now to double from here and it goes to $1,000 a share, for example, I still don't want to make any changes based on that. I want to allow it to continue to run. Of course, there would be a point where it becomes so much money that it just wouldn't make sense, and that's kind of what I hope for. But in the meantime, I try to think of the original investment, why I put it there, and not pay attention. I feel the same way about Google. I feel the same way about Amazon. And I would feel the same way about any other great company that runs like that. I then do have an account in my possession that is strictly meant for dividends, and I take a little bit of risk, and I have a bit of I hate to admit I get some what's it called when you get over attracted to the yield. So I definitely buy some that have some higher yields, and one in particular I probably have a few too many shares in. But to be fair, I actually reached out to the company and I talked to them directly, and it gave me some comfort, at least through 2027, that their contracts are in place and what they've guided should actually be what happens. So they have no concern. And then when their contracts expire, they have to renegotiate. Now, those of you who are curious, that's NextEra Energy Partners, which I have a little bit of. And I reached out to them, and I was really impressed that they actually responded because it wasn't because I'm some huge stockholder. I was just really impressed that they actually responded. I then had a Zoom call with one of the people who works for the company who talked me through where they are and reiterated essentially what they've said in their guidance, which is over the next few years, they expect to be able to raise their dividend exactly how they thought it was. And I bought the stock for the dividend. Again, not financial advice, but to me, I think the stock is worth close to $40 or $45 a share, where it would be paying an 8% dividend instead of the 12 or whatever it is currently, just because for a company in that space should get a good return, but it shouldn't be anything like it's giving right now. And as long as they're not having real problems, well, it shouldn't be discounted the way it is. Again, you need to do what's comfortable for you. Part of why I reached out to the company is I thought, geez, it doesn't make sense. And he felt the same way. I'm comfortable enough that I don't overtrade the dividend account because I really do want those dividend checks. And that's why I've bought those stocks. So I don't look to buy and sell things in there. Target, which I've talked about in the video, I was fortunate enough to pick up when it got below $110 a share, simply because the dividend started becoming really good at that point. Similarly, I did the same with Best Buy, and I actually have a little bit of Cracker Barrel for those of you wondering some of my positions. And Cracker Barrel in particular, I'm a little bit concerned that they may have to lower or cut their dividend because right now they're making less than what they pay out in their dividend. The only thing is we actually part of why I bought it is I stopped at one of the stores on a trip out to Utah and they were super busy. And it, if I worked for them, I would be suggesting they raise their prices. I think that with inflation and seeing what other restaurants charge, and those of you who get annoyed at me telling them to raise their prices, I get it. But I felt like they were a little too inexpensive for a sit down restaurant with what they serve and compared to other stores. Now, maybe that's how they build their client base and why they stay so busy. But really, with McDonald's charging, $16 for a Big Mac meal, I think they have room to raise prices, which would, I would think, help their margins, help their profits, and help them be able to pay that dividend. But I'm just a guy on YouTube. I have no clout. I have no say at Cracker Barrel. That's just my own opinion from being both an investor and somebody who stopped there. Now, back to the original point of the video, buy and never sell, and if you can, buy low, sell never, is a really valuable strategy as long as you're in the position to do it. You should live off your income, continue to invest the best you can, and own great companies for as long as you can until you really need that money to retire for something else. I've told this story a few times. When I was in high school, I was in a really fortunate position where my grandfather wanted to give a gift to all of his grandchildren. He gave each of us $10,000, and there were four of us in my family. Um, my mom, being my mom, took it from all of us. She didn't want us to buy a motorcycle or anything else that a kid that's an idiot might do. And I went to her and argued with her. When she looked at me, she's like, "Well, what do you want the money for?" And I said, "I want to put it in the stock market." She looked at me like I was nuts, which I understand. I mean, I was like 16 or 17 years old. And then she was kind of like, "Okay, what companies do you want to buy? Why don't you write down a list? You can show it to me and we'll talk about it." So the companies I wanted to buy were Chrysler, Eastman Kodak, General Electric, one that I constantly can't remember. It drives me nuts every time I tell the story, and McDonald's. What's really interesting is Eastman Kodak, Chrysler, and General Electric all kind of went out of business. I know you see General Electric go across the ticker, but it is not the one that I bought in the 1980s. Well, take those and put them at zero. And I put $2,000 in each of these companies. McDonald's has split three times since I put $2,000 in it in 1987 or 88, somewhere around that time. Now, McDonald's was already well established. There were already stories of so and so's grandmother who put $1,000 in it when it started, and they were millionaires. Well, if I still had those 100 shares, they would now be 800 shares. Mind you, I do not have 800 shares of McDonald's. But the 800 shares at $300 a share, I know I've rounded up, would be $240,000. If you take the $10,000, even with the other companies going out of business, it did just fine over the past 40 years, which is my point about picking great companies. You don't have to be perfect. You don't even have to do that well. Here I was 16 or 17 years old. I picked terribly and still did really well. The $10,000 investment would be worth at least the 240,000 of the McDonald's. I actually sold my Chrysler to buy a computer back in college. I don't think I made or lost money. And I don't know what that fifth company is, so it's possible it had value as well. That is how I feel about any great company. And it's why I don't worry too much about today's earnings. My outlook is 10 or 20 years, and it's only shorter than 40 simply because I'm older. And despite my concept of it'll be left for my son, hopefully I don't get run over by a bus and I'm able to move that into a dividend and able to just live off of those dividends, which is really my goal. And, you know, I see all the complaints in the comments, and I see other comments as well. Look, everybody has a different retirement goal and how much money they need. There are enough people in the comments who talk about I saved $300,000, I get about $1,000 a month from that. I then have Social Security, and so does my spouse. And despite everybody else complaining, we survive on it just fine. It's about living below your means. Now, I have a bigger budget. Most of you would think I'm out of my mind, but everybody is in a different category. So when I watch those complaints about how bad the economy is, how unfair it is, and everything else, I would kind of think about that stuff. When I was young, I had roommates. I saved every penny I could. I contributed to any opportunity of a 401k plan or any investment plan. I paid me last, which I've seen people talk about that in other videos. But as much as I thought I could save, I would save. And it was just the way that my head worked because I hope to not work one day. It was out of my laziness. So, any of you who has a goal of not working at some point, my suggestion is work as hard as you can, as young as you can, and save as much as you can, living well below your means. It's not always fun. Don't go for guys, don't go spending it on girls. For whomever, don't spend it on drinking and going out and whatever else that gets expensive. Because one day you'll be really glad that it works out. The more you put away and the longer you give it, the better you'll do. It really is that simple, but it's about, you know, waiting for the future. It's about, gratification in the future and not right now. The other thing to make it fun is invest in what you know about. Don't, or it doesn't matter what it is. Again, you need to do your own research. This is not me, but pretty much anything you find that can be interesting is a collectible. When I was a kid, I liked baseball cards. Those have been collectibles. If you like artwork, if you like wine, thing is, you just can't drink it. You really have to look at it as an investment. My wife really likes purses. I've tried to talk her into paying better attention and buying those as an investment. Because to be perfectly fair, there are plenty of really valuable ones that continue to go up in value. They become more and more desirable. And if you keep them, museum quality, and take good care of them, to be fair to her, they really do go up in value, and people have made those a collectible as well. I just don't know anything about the industry. Shoes, my God, I kicked myself, pun not intended. But those Jordans, I could have bought them when I was a kid and just left them in a box and they're worth a fortune. But whether it's sneakers or this or that, like really anything that you know about that you think you have an edge on the rest of the people, like that can be an investment too. It doesn't have to be stocks. I just like stocks. It's one of the things that I really gravitate to. And part of what I like about them is that part about as I get older, I can transition into dividends that will help pay my retirement. Now, if you were fortunate enough to buy something really good, like a pair of Jordan shoes, you can sell them, take that profit, and put it in something that pays dividends as well. Anyway, I could ramble all day because this is really a subject that's near and dear that I love about, suggesting people to save. I'm really excited. Some friends of ours asked if I could teach their kids. I'm hoping that we get to do that. And actually, if I do, I'll probably record it because I think it's fun. And, the kids are really opening to learning. And that's when I started. My mom would talk about it, and I found it fascinating because, again, my laziness, I thought, wait, so I can just save money, and if I put it away, one day I don't have to work. Like that sounded really attractive to me. So the funny thing is, I actually enjoy working and trying to save because that gets exciting to me to watch the account grow. Anyway, thumbs up again, subscribe, like, tell me your theories on it. Tell me what stocks you like. I mean, I like that end of it too. I'm curious which ones you think are good investments. So enjoy your Easter, and I'm sure I'll talk to you soon.